So this is a topic, the fundamental of capital budgeting, right? I hope you know this topic is in response to your first question. And what was the first question? How do you decide? Sorry?
Investment.
Yeah? Long-term investment. That how you decide. If you are a company established or a new you can have multiple ideas. Question is that which of those ideas you will be implementing and what will be the basis of your decision? That we shall study in this topic. Capital budgeting is a very important topic. Capital budgeting, I'm reading as such so that I don't deviate. Capital budgeting is the ex ante process that corporates apply to determine and evaluate high value expenses or investments. Remember, you don't spend millions of dollars every day, as I said before. But these millions of dollars which you spend can determine the future of your organization. Okay? Because if you spend millions today, you will be making use of those projects for many, many years to come. So it's like a long-term investment. And it's also, the word is ex ante, which means that you don't do this calculation after you have done everything. You do it right now before you do. So everything is based on forecasting. Disclaimer, you can ask me many times, how do we estimate? Well, we make estimation based on some assumptions. Of course, these are limitations, but there's no other choice. What can we do? We make all this calculation based on our estimates, based on our perceptions. Estimates, perceptions, even our biases. If there are two managers and they are considering the same project, they would end up with different calculations, believe me. You know why? Because the way they see the future growth is different. One of them can be seeing very rosy future, and one of them can be seeing very, very doomsday kind of future. And they both can come up with different calculations. It's a reality. It's a fact. So there's a lot of perceptions involved in it. But as long as you have a reasoning, because you know what? After you make this calculation, you show them in your board of directors, so people who are around you, they ask you that, could you please explain these calculations? And if you are able to convince them, or let's say fool them, it's fine. But if you are not, then you have to revise your estimates. Okay? So all the companies in the world, they never do capital budgeting. The project is after the project is completed. No, they do it in upfront, in the very beginning. I use a phrase in time zero. Time zero is now. So they do all the calculations now, even though the project life could be for 10 years or 20 years. If you look at some public sector projects, building a bridge, for example, or making a dam, or laying a railway track in a country, that involves hundreds of millions or sometimes billions of dollars, doesn't it? But the project may not be completed before 20 years. All right? Should we not make the investment project implemented just because we say that, how can we estimate? How can we forecast? Well, we have to start. And that is based on forecasting. We have to estimate that how much you will be spending on the project every year. And you also have to be prepared that, you know what, there could be many, many years when there's no output. You are not producing potato chips. If you are making computer chips, it can take you many, many years before the project is completed. So you have to spend for many, many years. And the cash inflow, if it comes, could come after many years. So you have to make a financial plan for it. This is the capital budgeting, where we make all kind of forecast estimates. And if the project's outcome is qualifying your benchmarks, then you reckon, oh yes, tick, this project qualifies to be considered. I'm not saying that every project which qualifies you implement unless you have limitless money. Since you have the limited resources, you can only take up those projects which qualify according to the capital budgeting techniques. And then out of those shortlisted or filtered in projects, then you find the next order, the filtering process, and the next order and the next order. Ultimately, when you have the very creamy layer, the final chunk, then you decide, okay, these 3 projects we shall implement, and all the other 50 projects we shelve them out. So this is a very multi-stage filtration process. Okay, so and many times I often say that in capital budgeting, we not choose what we do, we rather choose what we don't do. All right, so that the only leftover is what we do. All right, this is what we shall learn in this approach. The first technique we apply is the accounting rate of return, or as you can see, ARR technique. Before I go any further, if you are a company already existing, then to apply this ARR technique, you look at your historic data. You look backwards, you go in the history. But if you are a startup, like majorly that we are focusing in this course, new venture, either you have no history at all, or you have very limited history. In that case, you have to find some suitable comparables. Comparables? Some companies who have some history, who you can benchmark against with. So in that case, and then you do the calculation based on those companies, and then try to, after you do the calculation, then you adjust yourself, making some adjustments. All right, but the point I'm trying to make is that if you are a company who have no history, in that case, you still apply these techniques, but in that case, you pick up some comparables. Some comparables. I give you one example. 2 years ago, a media company, a local company which make apps, they approach us that, could you do a project that, because they went to some bank and the bank rejected their loan because the problem with the new enterprises is that they're so much obsessed with the ideas that they don't really care about funding issues. And they thought that just because they are so much impressed with their own ideas, self-intoxicated, okay, the bank will also like them and give them money. But when they went to the bank for the presentation, the bank clearly said them, no, you can't justify your ideas. And since I knew them and I offered some help, that okay, fine, we can do some help to you. And then I employed three of my students to this company. And then we did this kind of valuation, forecasted valuation technique, capital budgeting technique, okay? And we applied many techniques. In that case, we took some comparable companies because this company was a tech company, okay? It could be one ladies' show, one man's show, but all the external industry sector, economic factor, which affect all the big tech companies would also be affecting to this company as well. Are you with me? If the oil prices are going down, then it not only affects BP and Shell, it also affects small oil companies as well, because the macroeconomic factors are the same. If inflation goes up, or the interest rate goes up, or the GDP forecast goes down, it would affect all the companies in the country, won't it? So there are some commonalities. Of course, there is a size effect. There are many other effects which we can adjust. So then what we did, we took 25 comparable companies in Finland who are either almost same what that company does, or nearly same. And then we did some rigorous budgeting, capital budgeting tools we applied based on their historic data. Because this company has no data. This company didn't exist, no history. And then we tried, after we did the calculation based on those 25 comparables, then we filtered out extreme values, which are too optimist or too pessimist. And then we chose the middle 50% companies and took the average of that. And then we did the adjustment according to this company's own situation, right? So the point is not that I should tell you what I did. The point is that after doing this multi-stage filtering out, we were in a position to make some estimates about the company's forecasted growth rate. That growth rate, what we forecasted, may not be true. I mean, when you see in the hindsight, let's say we did this calculation in 2017, right? And let's say we fixed a growth rate of 7% for next 3 years. And then comes 2020. And then you see that, hey, your forecasted was 7%. What you have realized is 5%. The point is not that. Point is that when in 2017, in time zero, when you go to a funder, financer, are you able to pitch yourself convincingly? I didn't say 17%. I didn't say 77%. As long as this number is justifiable, arguable, presentable, it's okay. When you do the pitching to your funders, have you seen, if you watch some on YouTube, there are many YouTube videos where people are pitching. They have no record, but they may end up getting thousands of dollars based on how well they can convince, because people who are sitting across the table, they know, is it inflated number or is it what it is? Because they really grill you. So the point of the matter is that after we did this report, it took us 4 months to do it. Then this lady goes to the banker. I won't say that the case was accepted, but the case was considered at least. It was not rejected straight away. All right. So the point I'm trying to make is that it's a disclaimer that please don't ask me that how can you get this number from? Well, either if you are an established company, then you compare yourself with yourself. You compare your future prospects today, what you've done in the past. But if you are a company which has no track record, then you compare yourself with some comparables, some suitable comparables. But you have to be very careful which comparables you pick up. Okay? If you are a tech company and your comparables are furniture or cosmetics or the textile companies, no, that's not good. Or if you're an oil company in Finland and your comparables are oil companies in the US, no, not good. So you have to develop some kind of parameters that who are your comparables. And then you are able to, and that is exactly what you will do when you make your finance project, a financial plan for a company. So you'll be assuming that, hey, what if I start a company? So it means, first of all, you have to ask yourself, if Shab has given this task, what should I assume? Which company I should start? Okay, all right, this is the company. All right, I want to start a media company. Then who should be my comparables? All right, find them. Or if you can't find many comparables, then don't choose the company. Change your options. All right. Yeah. The point, what I want to check is not which company you choose. The point is that have you understood what is meant by a financial plan? What are its characteristics? What are its objectives? Are your calculations based on some realistic vision? And more importantly, are you in a position to justify me and people? Because when one of you will come here, then all of us remaining are basically can quiz you. Are you able to face our questions? Can you convince us about your problems? Of course, we will not be picky on you. We can be even giving you some suggestions. It would be very positive, very healthy environment. But the question is that I really want that at the end of this course, you should be in a position to pitch yourself. Okay, so this has something to do with how you communicate with the others as well. So I think in this example, before I explain how this is calculated, I have given you a bird's eye view about your assignment, that you will be preparing and presenting a financial plan of an imaginary company. Okay. If you can do something for imaginary company, I'm sure you can have. And that is based, even though the task is imaginary, but the parameters, the questions, the debate, discussion would be very, very real. Please keep in mind. All right, so we calculate the accounting rate of return. In this case, I have picked up the company, and I assume that this company exists already. So I'm not picking up a startup. So, or maybe I'm a startup, or I pick up one comparable company, which is the best fit to my company, but this company has the record, right? So you can see that I make comparison of a comparable company, but not for 1 year, but I take multiple years, so that more the data, better it is. So you can see that there's a revenue. Then we have expenses. And if you have the revenue minus expenses, you have the earnings before depreciation, right? So if you minus this number, can you see the cursor here? Yeah. So if this is expense from here, if this is a revenue or a forecasted revenue minus the actual or the forecasted expense, it leaves with you earnings before depreciation, okay? Tomorrow I would show you the actual, because this is a example, so I can't show the full income statement, but tomorrow I'll show you the full income statement and give you idea how to calculate this profit. I'm coming on that. I'm coming. I'll explain it. So that gives us the earnings before depreciation. We have a word for earnings before depreciation. Do you know that? We have it's called operating profit. Operating profit. Okay. Can I ask you one thing? Now you have to help me now, yeah? You have no choice. If I'm a furniture making company, let's say I manufacture furniture here in Uvascular. And let's imagine that revenue is very straightforward. Let's say that I know for sure that my revenue is 2 million euros. Okay. What are the costs? What are the costs involved? Okay, let's go one by one. The first cost is labor. Raw material, yeah. Say again. Energy, yeah. That's not expense because that's a asset. Let's say not the car, but the engine oil and these kind of things. You mean? Huh? Maintenance. Maintenance. Let's call it maintenance. Yeah. Did you say? But the place, actual place, or the rent you pay? Because the actual place could be the full value. We can't. If I buy a piece of land today, I can't show in the 1 year's record. It has to go for many, many years. Rent could be. Why not? Huh? No. Rent. What I'm trying to calculate here is that what are your operating expenses? Operating expenses mean all the expenses which help you to operate. Which period? Yeah, the period. Oh, all right. Okay. So rent is, do you consider rent as operating expense? Can you operate without land? And if land is important, then rent is also important because you pay for it. But anyways, the point is not how many, but the thing is that if you look at these expenses, these are directly concerned with, I'm not saying production, but operations. Production is one form of operation. Even when the furniture is ready and I'm loading it on a truck, all right, the money which I spend on transportation is also operating expense, even though it's not manufacturing expense, but it's operating expense. I cannot operate unless I have the transportation expenses. The point I'm trying to make is that these expenses are called operating expenses because these are directly, without them, I can't operate. Okay, let's say these are 120 million altogether. Okay, then the leftover would be 800,000. This is called operating profit, or I would call it gross operating profit. Okay, gross operating profit. Then comes the point you said that if I buy the land or if I buy the machinery, well, I can't take all the value of the land and machinery in 1 year because machinery and land will go for many, many years. If I buy a machinery, look, if you buy a car and the car is costing, the brand new car is costing you 25,000 euros. And let's imagine that car's life is 10 years estimated, right? So 25,000 divided by 10, it means that every year you're using 2,500 cars value. Okay, this is called depreciation. So we minus depreciation. Depreciation is the expense due to the wear and tear of some assets. All right. So every year you buy a car today for 25,000. You don't show it as expense straight away because the car, come on, it's rent is this month's rent is for this month. So it's expense. But you can't show the land's value because land will go for many, many years. So you have to divide the value of land for many, many years. Like the land of, like the price of building or the price of machinery or the price of furniture, likewise. Anyways, so if this is depreciation, let's say this is 100,000. This is your net operating profit. How much? 700,000. My question is that, is this the only expense you have to spend? Very good. Taxes. You pay some tax. Anything else you pay? Yeah, your financial expenses. So can I include the interest which I give to you? You remember the interest? All right. Before I pay tax, this is a strange world, isn't it? Before I pay tax, in the reality, we pay interest. Okay? In the reality, in the model, forget about, they were not in the order, yeah? We always pay interest before. Okay? When I pay interest, let's say the interest is, which I owe to three of you together, is 100,000. Sorry, 100,000. I'm left with how much? This is called gross profit. Okay, or I have another name for this: profit before tax. Profit before tax. Remember, there's a difference. If you look at these expenses and these expenses, can you find some difference? This has nothing to do with your operations. Interest, I know money is very important, but it doesn't show that you. Huh? because it's only in the fall in the value. There's no real monetary expense. Look, when I pay you wage, do I pay you cash? All right. Depreciation is no cash payment. It's only an calculation in the books. Yeah. These all are explicit expenses. This is an implicit expense. So depreciation is an implicit expense or an internal expense, or it's expense in your head. You keep in mind, but you don't really pay. Yeah. There's no cash transfer. You paid the cash when you bought car for 25,000 euros. That's it. For the rest of the life, you will only deduct 2,500 each year. That's it. All in the book. Yeah. And then you pay interest, right? Which I paid you, right? And let's say now I left with 600,000. As I said, this 600,000, which I call gross profit, often we call in the accounting words profit before tax or earnings before tax. The problem is that I don't believe that profit and earnings are same thing, but there is a conceptual difference. But mostly in the account, all these accountants of the company, they mix up terms and they consider that the profit and earnings are same. All right. So if you see some company's book of accounts, and if you see the word earnings here instead of profit, don't get shocked. Okay. Okay. All right. Now we have the earnings before tax. What should we pay next? The name itself clarifies. Tax, because it's earning before tax. So it has to be earning after tax. All right. So then we minus tax. And let's say we pay 200,000. 33 is 33%. It's less than the corporate tax rate we pay in Finland. So it's 33%. 33% is not, companies do pay 33%, even in the very capitalistic countries as well. And then you are left with 400,000. This is called your profit after tax. Profit after tax or earnings after tax. Okay, or net income. Look. They call it income. Okay, but anyway, the idea is that you are in a position that you can calculate the net income or net profit or the profit after tax. So these are synonyms. So you should be able to calculate them. And once you have them, look, we have the data for 5 years, yeah? There are some situations when there are losses. Okay? And when there are losses, of course, we adjust for it. Here, there was profit. Here, you pay tax. This is interesting, yeah? Yeah, I tell you something. The year you have the losses, right? Then you may receive tax credits from the state. So the tax refund, in other words, the tax you paid, you are getting some refund from the state. So it's a negative tax. So in other words, the state is paying you. Why? Because it's in the interest of the state that if you have a loss, you should be treated nicely. State would be never willing you become bankrupt. You already have a problem here, yeah? And on top of that, state still take tax from you, your loss will become even bigger. So in other words, state is giving you a refund. So that look, when you get the refund, your losses are less now. So it's like a, getting some oxygen. The company is dying, the company is in trouble, and you get some oxygen from the state. So it's like a accommodation or helping you to sort out. Normally, in the US law, you can, if you have paid taxes in the past, so the past 6 years taxes you have paid to the state, you can recover in the event of losses, right? So there is a possibility that you can get the refund from it. Anyways, so this is the average. So what we do here, we have the average net income. or the average profit after tax, or the earnings after tax, or average net profit, whatever you call, different, because all the accountants don't use the same words, of course. Why should they use? Huh? No, no, no. It will not be confusing when you see the final figure, when you see the income statement of a company. Let's say you have 5 comparables, right? And you see their income statement. You might not have to calculate all these things. You straight away can see their final profit. So that is their net profit or the profit after tax. This is why I was telling you that one purpose of this course is to get you familiar with the different phrases. So it's very important for you to know that in many cultures, in many countries, income means profit, means revenue. Yeah, so there could be different expression. But as long as you know, as long as you know, my point is not to debate why they did this. As long as you know what you get finally, when you look at the layout, whatever they write here, I will not pick up this. Whatever they write, I don't care. But what I know is that the final, what's the final? What's the residual? That's more important. Whatever they call it, it doesn't matter, as long as I understand what it means. Okay? Of course, you should know. And then we are able to find the average of certain years. 5 years is not a bad year, bad time period. 5-year statements are pretty representative because 5 years is a long period. Company must have seen different ups and downs. And then this is the average book value. Now, you bought the plant machine for 500,000 in time 0. In time 0. All right. And this company remains for 5 years. So let's say, like in case of just current example, bought a car for 25,000. All right. The working life is 10 years. Okay. In this case, we assume that the working life of the project is 5 years. And after 5 years, the terminal value is 0. It means that if you sell this plant machine after 5 years to a junk dealer, he will give you 0, nothing. So now, just like you find the average of 5 years, you can find the opening value and the closing value. The opening value is, I'll come to you. Opening value is 500,000. Closing value is 0. So between two extremes, you can take the middle value, which is 250,000. Okay, this value you can use as a kind of average representative value, and that when you make some calculation, you can get some idea that the average rate of return on this company's investment is 20%. You can do it for one company for many years, or you can do for different companies. So you can take multiple. Let's say I'm a startup and I have 5 comparables. Then I can get the 5 comparables and find their average. So let's say one comparable gives me 20%, the second gives me 18%, other gives me 12%. So then I can do the same thing 5 times and find the average of average. Does it make sense or not? This is company, yeah? This is one ARR. I can find one more comparable company and do everything same. And that is 18%. And then I have another company, C company, and I find their average, all the calculation comes out to be 15%. And I say, okay, 3 are enough, 20%, 18%, 15%. I take their average. I can use that as a benchmark. Yes. But in this case, I'm taking only one company, yeah? Average book value. The book value is when you bought the machinery. The machinery you bought for 500,000. So in the books, the company's value is 500,000. But at the end of the period, the book value is 0. No, the average. Average. Look, here I'm taking 5 values. Am I taking 5 values here? Yeah. Because I took 5 years. But here I'm only considering the first year and the final. So 2 values divided by 2. Machine's value. You can do that. That's the one way of doing that. You can subtract depreciation. But if we assume that, look, see, it depends upon your perspective. If I assume that I buy this computer for 800 euros, and at the end of 5th year, this computer has a 0 value, then I would say, even though the years are 5, but I would say that on an average, during the middle, even though but if the 0 value is 800, when I buy the computer, and the final value is 0, and the middle value is 2.5 years, is 400. So that's why, even though in this case, even though I'm using this computer for 5 years, but I have only 2 values. 2 values mean I will not divide by 5, but by 2. All right. Whereas this, for the revenue expense, you can get the data of the company for each year. But you have a point that then why don't we subtract by the depreciation? Well, I'll tell you something. What is the value of the machine? 500? Yeah. How much depreciation you have? 1. So it means that after the year 1, the machine's value is 400. You yourself said, when did you buy this machine? In time 0. 0 means now. How much you pay? 500? How much is depreciation after 1 year? 100. What is left then? What is depreciation next year? What is the value after 2 years? If you keep doing it, definitely at the end of 5th year, the machine's value will be 0. And why we write book value? There's a reason why we write book value. Book value means the value only in the books. I can still use that machine. If this computer has 5 years book value, it doesn't mean that after 5th year, I will throw this computer in the bin. This computer may still have some functional value, but in the books of accounts, it will have a 0 value. After 10 years, you can still drive your car, but that car's book value will be 0. It can still have a market value. It means that if you sell this car on 12th year, somebody can still give you 1,000 euros. It means it still has a market value, but the book value is 0. Because we don't see it after how many years we've driven the car. We forecast in time 0. Please don't forget time dimension. We are doing these calculations not after 12th year. We are doing it now in time 0. I don't know, your car can go for 20 years or your car can break in after 5th year. And these are based on some reasoning. I mean, if you have a planned machine, okay, 5 years is a normal life. If it's a computer, maybe 5 years, maybe 3 years, depend upon what. If you have a dam, if you have a bridge, let's say you have a bridge in flyovers, it can have 10 years value, working life. Maybe after 10 years, you have to rebuild it or at least make some changes. So every asset has a working life. This land can have limitless value, but the building has a limited value, isn't it? Sorry? Because you are calculating the average profit, that's why. Because you're calculating average profit. Look, this profit is for 5 years. So if I take the profit for 5 years, and here I take full value of the plant, that's a little bit absurd. So this 250,000 shows what? That when I bought this machine, I invested 500,000, and at the end of how many years? 5 years. The value is 0. So between 0 time and 5 years, the average is 2.5 years. And the value is going straight line. You know, every year there is a 1,000. So it's a straight line going down. The average of 0 year and 5 year is 2.5 year. Okay, that would be this value. If I only take 500,000, then I, in a way, assume that the machine's value has remained same throughout. So the machine's value is not like this. It's not like this. That it remains same for 5 years. No. It goes down over time, because that's why we introduce the word depreciation here. You can see, okay, do one thing. You can ignore this. But why we divide by 2? You can see that the machine bought for 500, 1 year, 300, 200, 100. All right. And even if you add the values, so you have after 1 year, the value is how much? 400. So you can try this one. 300, 200, 100, 0. So maybe if you try this way, 7, 9, 10. Divide by 5. Maybe you get some other number. So I'm not picky about this. If you have a point, you can find the average value. You can find the value like this also, and then divide by 5. That's possible. As long as you consistently follow this formula, it's fine. Okay. Please go to the previous slide. Then it's the average rate of return. Huh? It tells you that if you have a comparable project and you are taking a comparable company and you are considering the company's performance for a certain time period, then how much on an average you can get the return from a project.
The rate of return of one, the rate of return of machine 2. And then you choose, okay, let's invest in this or that. So this
but still I can explain it. Accounting rate of return lacks some economic substance because it only remains in the eyes of books. It doesn't take into account the market dynamics. So it doesn't take, there are certain things in the books and certain things in the market. So it doesn't incorporate the market dynamics. It's only based on the book value. And secondly, the accounting rate of return ignores the time value of money. Because here, if you see this calculation, you will find that we assume that the money value remains same, whether time 1 or time 5. But we know that the time value of money changes. Inflation is a big reason of the time value going down. Interest rate rise could be another reason why the time value of money can go down. If these projects are spent outside of your country, then the depreciation of your exchange rate can be another reason that the value of the money can change. Okay, imagine this project you are benchmarking is not in Finland, but let's say in Malaysia, and the Malaysian ringgits are depreciating as against the euro, then even though the numbers will not reflect it, but the fact of the matter is that after as the time goes, the ringgit, when you convert to euro, will give you less money. So the thing is that these are not incorporating some macroeconomic realities, which includes inflation, interest rate. Whenever the interest rate increases, the money value you lose the value of money. Or when there is inflation, the money value is lost. Or when there's a depreciation of the currency, if it is a foreign project, then you also lose the value of money. Okay. If you are an exporter sending things from Finland to US, and the US importer or a customer will pay you 5 million next year in 2020, and then in 2020, dollar depreciates against euro, then even though that guy will still give you $5 million, but when you convert them to euro, you will get less. So these hard dynamics are not included in it. And definitely this is not a very good measure. And by the way, we never use only one measure. Okay? We use multiple measures of capital budgeting. So not one single measure is perfect. We apply a matrix of measures. Okay? Cash flows and the market values are better measures. Cash is the king. Cash is the reality. Profitability could be manipulated. And I have two files for you, which will show, even though it's a very basic calculation, but it would show you that how, without violating any legal problem, we don't violate any law. By remaining legal and everything fine, we can still manipulate data. So you don't have to do illegal things to manipulate your financial data. You can do everything legal, but still can manipulate data. And I want to show you an example. Let me pause.